After studying this module, you shall be able to 1. Know factors responsible for growth in service sector, learn the concept of cost disease hypothesis, identify the growth of trade in services, evaluate the structural change in India's economy after independence, and lastly, analyze implications of cost disease hypothesis. Introduction. Indian economy has experienced substantial changes and improvements in its GDP growth performance over the past 3 decades, with average rates of growth growing up and fluctuations coming down. Introduction of economic reforms in 1991 is seen as the turning point in India's post-independence economic history, providing a break from the low growth trap where the country's economy is caught for as long as 4 decades. Economic growth has been accompanied by a changing sectoral distribution of GDP towards high productivity sectors, in particular services from industry and agriculture. Structural changes and economic growth in services. Linkage between structural changes and growth. Over the time, economists have argued that the high growth rate of GDP that was triggered off by the economic reforms mainly of 1991 and has been sustained over the years has been the most crucial achievement of the Indian economy in recent years. The explanation of the growth and structural change is that the structural change is not expected to affect growth, but instead occurs as a result of the growth process. Sectoral changes in output are thought to occur as development proceeds because the income elasticity of demand for agriculture products is low, while for industrial, particularly manufacturing goods, it is high, and for services, it is still higher. With increase in income, the demand for agriculture products relatively falls, and for industrial goods increases until after reaching a reasonably high level of income, demand for services increases sharply as well. Accordingly, the shares of different sectors in output are affected by the changes in demand pattern which accompany growth. More recent approaches to structural changes view economic growth as a process of transformation and not converging to growth path at a steady state level. Technological changes are seen to lie at the heart of economic growth as they provide the incentives for capital accumulation to drive efficiency and yield the benefits of increasing returns to scale. The evolution of industrial structure should involve technological sophistication and upgradation, which generates a premium for growth of aggregate productivity in the manufacturing sector. This means that economic growth involves the creation of new highly technical industries and the replacement of old industries. The former drive growth processes by accelerating the pace at which output, employment and productivity existing in the economy grow. Structural change and its contribution to growth. Long-term economic growth in India is associated with changes in sectoral contributions to GDP. There has been a substantial shift in the share of GDP generated in the primary sector, mainly agriculture, to other economic sectors, namely industry and services. In the first decade and a half after independence, Under the growth regime, the share of industry in GDP rose faster than the service sector due primarily to heavy emphasis given to industry by the government. But towards the late 1960s, the GDP structure started slowly shifting in favor of services. The pace of growth of service sector accelerated in the late 1970s, with the share of agriculture in GDP declining and that of industry remaining almost stagnant. The late 1990s witnessed a drastic uplift in the growth of services matched by rapid erosion in agriculture sector share. Industry with great difficulty tried to manage to retain its share in GDP at almost the same level. 4 phases. On the basis of observed patterns of growth and structural changes, economic growth in post-independence India can be divided into the following 4 phases, each with its distinguishing features. Phase 1, independence to mid-1960s. In this period, a significant acceleration in the growth rate over the past decades was seen, which was marked by a high growth of industry and a significant structural change with increasing share of non-agriculture sector, especially of the industry in the national output. Phase 2, mid-1960s to 1980. This period was marked by a slower growth of GDP, accompanied by deceleration in the growth of industry, a slower pace of structural shift from agriculture to non-agriculture and a very small rise in the share of industry. Phase 3, 1980 to early 1990s. In this period, a sharp acceleration in the growth rate occurred, mainly contributed by services sector. Structural changes were also possible with a huge fall in agriculture sector share, but very small rise in the share of industry services, picking up the major share of the shift. Phase 4, early 1990s onwards. Economic growth was occurring at similar rate as 1980s, but it declined over the period 2000 to 2004. Structural changes continued at an accelerated pace with share of agriculture sharply declining and services emerging as major sector and with very small increase in the share of industry. Within this phase, period 2005 to 2010 has been a sharp acceleration in the growth rate despite a slowdown in 2008-9. Share of agriculture has declined from around 20% to 60%. That of services has increased from 54% to 59% and that of industry has stagnated. Thus, in the first 3 decades, the rate of economic growth followed that of industrial sector. Since 1980s, it has been primarily services led. The share of industry has remained at almost the same level, that is around 25% since 1987-88. Within industry, share of manufacturing has been constant at about 15%. Construction has increased its share mainly at the cost of mining. Contribution of manufacturing to growth of non-agriculture GDP was estimated to be 24% during 1950-51 to 1979-80 and only 18% during 1979-80 to 2007-8. Construction has seen a small decline in its contribution from 10 to 9%. Industry, including construction, saw a decline in its contribution from 40% in earlier period to 31% in the latter. Acceleration in the services growth occurred since 1980s. In aggregate, services grew at a rate of 4.6% during 1951 to 1979-80, 6.5% during 1979-80 to 1995-96, and 8.5% during 1995-96 to 2007-8. Contribution of services to the growth of non-agriculture GDP was 78% during 1979-80 to 2007-8 as compared to 69% in 1950-51 to 1979-80. As a result, share of services is now about 85% in non-agriculture and 60% in aggregate GDP. Structural changes. Changes in industrial and investment policies. The changes in industrial and investment policies in terms of delicensing, discontinuation of reservation of several sectors for public sector and liberalization of foreign investment introduced over the past 3 decades, especially since 1991, have led to several important changes in the structure of Indian corporate sector. First, the non-government joint stock companies have acquired the dominant position in terms of paid up capital, raising their share from a little over 1/4 in 1989-90 to 3/4 in 2009-10. Second, the percentage of private companies engaged in manufacturing fell from about 3/4 to 36% during this period. Third, the shift has been primarily in favor of finance, insurance, real estate and business services. The private corporate sector has followed the pattern of change of overall economy toward the services sector. The share of service sector companies in total assets increased from 11% in 1989-90 to 37% in 2009-10. There was a fall in the share of manufacturing. Fourth, de-reservation of sectors earlier reserved for the public sector has led to sharp rise in the participation of private corporate sector in them. So, in electricity, its share increased from 4% to 7%. Most important, in telecommunication, its share increased from nothing to 33% in IT, from 2.3% to 13%. Construction and real estate, ports and engineering construction are the other sectors where private corporate sector has increased its presence significantly. The early 1980s saw a recovery in the GDP growth due to both policy changes and external factors, but which crucially featured a rise in GDP growth supported by all the other 3 sectors. Industry grew at an average growth rate of 6.1% in contrast to 3.9% growth during 1965 to 1980, even if its share in GDP remained almost constant due to faster rise in the services. Within services, there had been a substantial shift away from low productivity vermilion sectors, namely community services and public administration, to high productivity businesses and financial services, followed by trade and hotels. Over the period, India has been able to move into the new activity, drawing on a large pool of underemployed skilled labor, which was created due to India's education and science and technology policy adopted since the late 1950s. The upshot is that increasing investment coupled with increasing productivity led to structural break in GDP growth during the 1980s. In this process, the services became the driving force with expansion in size and change in the composition. The rate of GDP growth was given another push in the early 1990s through radical reforms. However, towards the late 1990s, it started stagnating, first due to the East Asian crisis and then the global economy plunged into recession. In 2003-04, economic revival occurred worldwide when all the emerging countries registered growth. In India, it marked yet another turning point and a phase of unprecedented growth. This was led by explosion in the service sector, which had started growing rapidly towards the end of the 1990s, especially with the rise of growing exports of software and ICT enabled services, following the success of Indian companies in fixing the Y2K bug. Factors behind increased share of service sector. The composition of services has also continued to change in favor of the modern and dynamic services, namely transport, communication, financial and business, including the software and related services. On the other hand, the traditional trade, hotels, community and public administration services have shrunk in importance. The various explanations that have been put forward to explain the increasing share of services in GDP, investment and employment in the process of growth can be categorized as demand side factors and supply side factors. Demand side factors causes to increase demand for services as growth proceeds, while supply side factors improve the supply of services. Let us look at the demand side factors. High income elasticity of demand for final product services, structural changes which make contracting out services more efficient than producing them in the firm or household. Supply side factors, trade liberalization and reforms. 1. Increased trade. 2. Higher foreign direct investment in services. 3. Improved technology. Demand side factors. Let us look at the high income elasticity of demand for final product services. The high income elasticity of demand for final product services implies that at any relative price of services, the quantity absorbed of services rises more than the quantity absorbed of commodities as real per capita income increases. This explanation for increasing share of services in the growth process has been tested by many empirical studies. For example, Kravitzes et al. In 1983 and theoretical studies which include Balasa in 1964, Samuelson 1964 and Bhagwati in both 1984 and 1985. However, we find that the hypothesis that demand for services is income elastic tend to find support in early empirical work in the 1980s, but in the 1990s studies with better methodologies and better international data find results contrary to this. For example, Falvey and Jermil in 1996 used disaggregated data set covering 60 countries in 1980 and re-estimate income elasticity of demand for services. They reject the above stated hypothesis for the overall services, though confirm it for different types of services. Structural changes. Along with the notion of services being generally unprogressive, there are arguments about structural changes that take place with economic growth. Browne in 1986 argues that with increase in the monetization in economy, a major chunk of household activities is outsourced from the market. The measured growth of national income is therefore biased upwards, since such shifts in production do not result in a corresponding increase in total output of the combined household and market sectors. The reason for expecting these services to be technically progressive is the fact that these services arise due to specialization, which reflects economies of scale. Being a part of dynamic process of change in the economic system, they are not technically stagnant. Also, it has been pointed out that since the source of growth of these services reflects specialization of activities outside firms, they are independent of any demand influence. But in case the goods splinter off from services, as for example, when gramophone was invented, the musical services left behind very unprogressive and technically stagnant. But most of the empirical studies, for example, Francois and Renard in 1996, that test whether the rise in services sector is due to real change in the structure of the production or splintering effect, as argued by Bhagwati, find that much of this rise can be attributed to the real structural change rather than outsourcing or splintering. Pilat in 2000 find that rising complexities of modern industrial organizations, manufacturing activities have become more service intensive, both upstream, for example design and R&D, and downstream, for example marketing and advertising. He also stated that the competitive advantage of firms now depends more on providing specialized services like financing and after sales facilities than on production. Supply side factors, trade liberalization and reforms. Along with the demand side factors, there are also some supply side factors that lead to higher use of services as growth takes place in an economy. Three supply side factors identified are increased trade, higher FID and improved technology that leads to higher supply of services. The two main distinguishing features of trade liberalization of services vis-a-vis goods are: A, imports of services must be locally produced, and B, liberalization of services leads to enhanced competition, which is both domestic and foreign. Greater foreign factor and increased competition both imply a large scale of activity and hence greater scope for generating the special growth enhancing effects. In fact, if foreign participation merely substitutes for domestic factors and the sector does not expand, that is, the degree of competition remains the same, then there cannot be a positive growth impact on account of scale effect. On the other hand, even without scale effects and even if services sector does not possess endogenous growth attributes, the import of foreign factors that characterizes service sector liberalization could still have a positive effect because they are likely to bring with them the source of endogenous growth, namely technology. Along with trade liberalization, improved technology has also led to higher use of services. Electronics, information and communications technologies have now made services available even when the producers and consumers do not interact. Information technology, that is IT in particular, has led to manifold increase in the use of services. Moreover, service technologies have now allowed much more responsiveness to fluctuating or individualized demand patterns. Cost disease hypothesis. Baumol's cost disease, also known as Baumol effect, had been explained by William J. Baumol and William G. Bowen in the 1960s. It includes a rise in job salaries that experience no increase of labor productivity in response to rising salaries in other jobs which did experience such labor productivity growth. This goes against the theory of classical economics. The rise in job wages without productivity gains is caused as a requisite need to compete for employees with jobs that did experience gains and hence can naturally pay higher salaries. For instance, if the retail sector pays its managers 19th century style salaries, the managers may decide to quit and get a job at an automobile factory where salaries are commensurate with high labor productivity. Hence, managers' salaries are raised not because of labor productivity increases in the retail sector, but rather due to productivity and wage increases in other industries. According to Baumol's cost disease hypothesis, service sector growth is not real but illusion. In reality, service sector productivity is improving slower than that of manufacturing, and therefore it seems as if we are consuming more services in nominal terms, while actually consumption of services is quite less. This means that the increase in service sector is caused by low productivity relative to manufacturing. The implication of these hypotheses is as follows. Assuming historical productivity increases for manufacturing, agriculture, education and healthcare, he showed that US can triple its output in all sectors in 50 years. However, due to high productivity level for manufacturing and agriculture sectors, it will take substantially more employment in services to achieve this increase in output. The supply side explanation based on the unbalanced growth model of Baumol maintains that tertiarization is likely to stagnate economic growth because of differential productivity growth. His assumption is that service sector productivity increases less than manufacturing and agriculture sector productivity, since the former is characterized by faster expansion of service employment than of service output due to its higher labor intensity as compared to the latter. Thus, the share of employment in the service sector tends to be higher in high income economies, leading to deceleration of overall productivity improvement. This cost disease arises in the process of tertiarization as the economy grows and the demand for services becomes price inelastic, pushing the wage level to grow faster than the growth of labor productivity in the service sector. Yet another explanation to the predominance of service sector runs in terms of the dynamic impact of competition among firms, forcing them to leverage their core competence. The technical and structural changes in an economy makes it more efficient to contract out business operations that were done internally by individual firms. The splintering of industrial activity, which increases input demand for services from the industrial sector, pushes the service sector to grow faster than others, according to Gordon and Gupta in 2004. Secondly, the cost disease associated with tertiarization proves instrumental for bias distribution as it pulls the overall output down while pushing the service sector wage level up. This urban bias has grown significantly during the reform period. This is evident from the fact that while the urban share in the net output moved up from 41% in 1980-81 to 46% in 1993-94 to 51.7% in 1999-2000 and 52% in 2004-05. Its share in service output rose to 71% in 1999-2000 from 65% in 1980-81 and 1993-94. The urban share of NDP from services has scaled down to 66% in 2004-05 as per National Accounts Statistics 2007 and 2010. Finally, the outsourcing of business operations in industry, also known as splintering, together with the cost disease, will only increase the cost of producing the same amount of output. This has reflected in the decline of average total factor productivity called TFP, value for manufacturing from 3.9 to 2.1 between 1980s and 1990s as per the report on currency and finance of 2002 and 3. Let us summarize. To summarize in this module, we learned how structural change is not expected to affect growth, but instead occurs as a result of the growth process, and how economic growth and structural shifts favored services of India. There are 4 phases in which the sectoral composition of India is divided, and it was only 1980s onwards that service sector started to lead economic growth. Before that period, industrial sector or agriculture sector had larger share. There are various demand side and supply side factors which could explain the reason behind increased share of services in GDP. For example, high income elasticity of demand for final product services, structural change and trade liberalization. We also studied about the cost disease hypothesis, which means that a rise of salaries in jobs that have experienced no increase of labor productivity in response to rising salaries in other jobs which did experience such labor productivity growth. The cost disease arises in the process of tertiarization. As the economy grows, the demand for services becomes price inelastic, pushing the wage level to grow faster than the growth of labor productivity in the service sector, and also saw its implication in service sector of India.